Apple, Microsoft, Coca-Cola. What do they have in common? These companies pay dividends and reward their investors. Today we'll find out how you too can benefit from their success.
A dividend is a portion of a company's profit that it pays out to its shareholders as a reward for their investment. It is a way for companies to share their success with investors. If the company performs well and earns good profits, it can either reinvest those profits to further grow its earnings or distribute a portion of the profits to its shareholders in the form of dividends. This way, it shares a part of its earnings with you.
Dividends are a way for companies to reward their investors for their trust and the capital they have invested in the business. This approach keeps investors satisfied and motivated to hold on to the company's shares long term. Another reason is that companies that regularly pay dividends are often perceived as stable and financially strong, which attracts additional investors. This stability signals to the market that the company has sufficient profits and liquidity to sustain regular dividend payments. Dividends can also appeal to specific types of investors. Some seek stocks that provide a regular income stream through dividends, making them particularly attractive to those looking for a stable passive income.
Not only can dividends attract new investors, but they can also encourage existing shareholders to purchase additional shares or reinvest their dividends back into the company. This reinvestment can help support the company's growth and enhance its long-term prospects. Each of these reasons highlights how important dividends are, not just for investors, but also for the company itself.
There are many companies that pay dividends, including Apple, Coca-Cola, Johnson & Johnson, PepsiCo, and many more. However, each company varies in the size of the dividend it pays and how long it has been distributing dividends to its shareholders.
A dividend payout is typically expressed as an amount per share. For example, if a company announces a dividend of $1 per share and you own 100 shares, you would receive $100 in total. The size of the dividend is often determined based on the company's financial performance and its dividend policy. Companies pay dividends in different ways, with the most common being quarterly, semi-annual, and annual payouts. Quarterly dividends are paid every 3 months, which is especially typical for companies in the United States. Meanwhile, European companies prefer to pay dividends twice a year, once as an interim dividend and again as a final dividend. The last type is the annual payout. Annual dividend payments are common among some European or Asian companies and are paid after approval at the annual general meeting of shareholders. The company may adjust the payout based on its profits, market conditions, or its own investment plans.
When paying dividends, it is important to understand the key dates that affect whether you are entitled to the dividend. The first is the ex-dividend date. This is the day when the shares begin trading without the right to receive the dividend. If you purchase the shares before this date, you are entitled to the dividend. If you buy the shares on the ex-dividend date or later, you will not receive the dividend. The next is the record date. This date determines who is officially registered as a shareholder in the company's books. Only shareholders who own the shares on this date are entitled to receive the dividend. This date usually follows the ex-dividend date by 1 day. Next is the payment day. This is the date when the company actually pays the dividend to the shareholders' accounts.
Companies can pay dividends to shareholders in various ways. The first type is cash dividends. Cash dividends are the most common type of dividend. The company pays shareholders a specific amount for each share they own, directly in cash. The advantage of cash dividends is that they provide immediate income, which you can use or reinvest. Another benefit is transparency, as you know the exact amount you will receive. The downside is that it reduces the company's available capital, which could have been used for growth investments. The second type is stock dividends. With stock dividends, the company pays dividends in the form of additional shares instead of cash. The advantage is that shareholders gain additional ownership in the company without having to invest more money. The company also saves cash, which it can use for expansion or other needs. The downside is that shareholders may not receive immediate income, as they would need to sell the shares to generate cash. The last type is a special dividend, which is a one-time payout that the company gives to its shareholders. This is an exceptional event.
Why are dividends important for investors? First, a stable income is key. Many investors focus on passive income, and dividends are one of the closest ways to achieve this. This predictable cash flow allows investors to cover expenses without the need to sell shares, which is especially useful during market fluctuations when stock prices are volatile. But dividends remain stable. Another advantage is that dividends send a signal of stability. A regular and increasing dividend is a sign of the company's financial health and stability. Companies that maintain or raise dividends even in tough conditions demonstrate strong fundamentals.
The strongest advantage of dividends is that reinvested dividends and their regular payouts can significantly increase the value of an investment over the long term. A dividend strategy offers investors stable income, signals the financial strength of the company, and maximizes long-term returns through reinvestment. The combination of dividends and stock price growth makes this strategy ideal for a balanced approach between stability and growth, making it an attractive option for a wide range of investors. How to find dividend stocks? Investing in dividend stocks relies on carefully selecting companies that can pay stable dividends and have the potential for dividend growth. The key to success is focusing on firms with strong financial foundations, a long history, and a sustainable business model. At the same time, attention must be paid to two crucial factors: dividend yield and the quality of the company itself.
The dividend yield is one of the most important indicators when selecting dividend stocks. This indicator represents the ratio of the annual dividend to the current share price and shows what percentage of the invested amount you will receive in the form of dividends. For example, if a company pays an annual dividend of $5 per share and the stock price is $100, the dividend yield is 5%. However, it is important not to focus solely on the yield. An extremely high dividend yield can be a sign that the company is facing problems that may threaten its ability to continue paying dividends. On the other hand, a very low yield may not be attractive enough for investors. The ideal yield typically ranges between 2 to 6%, which indicates a balance between the company's stability and an appealing income. In addition to yield, it is advisable to monitor dividend growth, as it signals the financial strength of the company and its long-term potential.
An even more important factor than how high the dividend is the payout ratio, which indicates what portion of the company's profits is paid out as dividends. The lower the payout ratio, the better. A company must have enough cash to pay dividends, but also to reinvest in its growth. Companies with a very high payout ratio can be vulnerable if their earnings decline. Quality dividend stocks have a long history of stable payouts and strong financial health. Such companies, often operating in industries like pharmaceuticals, energy, or consumer goods, offer stable demand and growth potential. It's crucial to track the history of dividend payments. A company's financial stability, strong cash flow, low payout ratio, and low debt are key to maintaining sustainable payouts even during economic downturns.
In the next video, we'll talk about how to find strong dividend stocks online, which financial statements to focus on, and discuss the risks of dividend investing.
And don't forget to leave a like and subscribe so you won't miss anything from the world of investing. See you in the next video.